Let's get back to the markets and talk fixed income with the Fed kicking off its latest policy meeting today. Our next guest says that we're in a soft landing right now. She says she still sees about a 30% chance of a hard landing, but that the market thinks that situation is much less likely. Let's bring in Priya Misra, who is fixed income portfolio manager at JPMorgan Asset Management. Priya, let's just start with this idea that you think there's a larger shot of a hard landing than the market is really pricing in. Why is that?
It's because I would argue that Fed policy is fairly restrictive. I mean, if you look at 10-year real rates, we're getting close to 2%. The Fed is also letting the balance sheet run off. And there's big question about when do they start to cut, how much do they cut, and if they're a little bit slow. You know, when policy is restrictive, the lags are kicking in. I would argue recessions are always nonlinear. You know, every recession effectively starts looking like a soft landing. So we're in this, I would argue, very critical juncture. If the Fed is able to start to normalize quickly, and I would argue they can start in March, May, something in that time frame, start normalizing the balance sheet, start normalizing interest rates, maybe we can stay in the soft landing. If they're not that quick.
4% isn't normal? I mean, that sounds like we're locked into these next to nothing interest rates for forever.
Well, you know, I would say real rates close to 0 to 1% make sense. But look at how much inflation's come down. So if inflation is running around 2%, I would say normal is closer to 2.5% to 3%. So there's still, you know, room for rates to go down. We're not going to zero.
Inflation has come down, but there are some pretty inflationary pressures that are out there on the global scene that people worry could come back in. A lot of that has to do with the Red Sea and the shutdowns that you're seeing, longer shipping times. You haven't really seen it show up in oil prices yet, but that could happen if things escalate from here. And the one thing the Fed has said when you talk to any of these FOMC members is the last thing they want to do is lower rates and then have to raise them again.
Agreed. So, you know, I think as they sort of think about the balance of risks here, it's a lot more balanced. But, you know, you look at the labor market, even there we are seeing slowing. Wages have started to slow down. If you get a Red Sea-related shipping disruption, that's actually more negative for the corporate sector. It's more negative for the household sector. So I think the Fed then can still continue to lower rates. They have to be vigilant. But as long as the labor market's slowing, I think they'll feel more comfortable that service inflation, which is still high. Most of the disinflation we've seen has been goods-related disinflation. I think that's largely run its course. But if service inflation starts to continue to come down, we're seeing housing disinflation, we're seeing wages, I think that'll give the Fed some comfort that they can start to normalize. We're only talking normalizing. We're not still talking about Fed easing policy.
Yeah, and the Fed certainly has centered itself on that message, that it would just be normalizing. This is not a rescue operation. But you do frame it as a bit of a race against time, right? That you have to make sure rates they fit with the current macro backdrop as opposed to passively just becoming more restrictive.
Exactly. I think it's a very tough message, actually, for Chair Powell tomorrow because, you know, at one level, the economy looks great. Inflation's back to normal. The unemployment rate is you know, below 4%. Why should the Fed even cut rates? So I think they have to give this normalizing message. They have to realize that monetary policy is restrictive. But I think where the race against time will come if those lags, those long-awaited lags, start to impact consumption, start to impact you know, consumer as well as corporate confidence, that's when the Fed can actually speed it up. I think it's actually easier. The first 200 basis points of rate cuts is much easier for the Fed because it's still normalizing. When do they get into the easing? But I think that's really a 2025 story.
And I think this also really does get to this perceived, you know, disagreement between the Fed funds futures market and, I mean, human beings, you know, we have a plan, we have intentions, we have models, we have a framework. We can say what we expect, 3 to 4 rate cuts, maybe if conditions are right. The market realized things happen, you know, and there's a momentum to inflection points in the economy. So the Fed funds futures encapsulates a what-if scenario if you get the hard landing.
A bit of risk management.
Exactly. Yeah. Yes. I would say the market, the Fed's always going to give you their modal outcome, so the most likely outcome. The market's always going to price in this variety of outcomes. And there is that hard landing scenario. I know we don't like to talk about it, but recessions do happen. There's been a reasonable amount of time. We don't have that much policy space on the fiscal as well as monetary side. So I think if things start to slow down, that's when, it can actually spiral into a hard landing, and the market should absolutely have that probability.
You think a hard landing is something that would happen later this year, something that holds off to 2025?
Right now it feels like it's a 25 story, but if things can slow down faster, I think it could be a second half of this year's story.
And what does that mean from an investment point of view? I mean, does it mean you think bonds still look good here because, the risks seem to be skewed toward more slowing? Or?
So I might be the only one saying this, but I think Treasury bonds do make sense. So the hedging property of Treasury bonds that has not been prevalent for the last many years as the Fed was taking rates higher, that hedging property is here. I would say owning risk assets makes sense. We're in a soft landing. Do your credit work, understand business models, understand balance sheets, but own those Treasuries. If the Fed has to cut rates a lot more, those 5-year Treasuries have a lot more room to decline. So I would say owning risk assets, owning some duration, 5-year Treasuries, is a good way to sort of balance the fact that we're in this tenuous moment. It feels very soft landing, but you've got to keep an eye out for that hard landing risk.
We were also talking a little bit about the balance sheet. It seems as if the Fed's gotten lucky. It hasn't hit a critical point. The market seems to be able to absorb what's going on right now. Is it just steady as she goes, or do you expect them to just essentially, have it find a level and plateau?
So I think the Fed is a lot more humble about quantitative tightening this time around. In 2019, we had that repo spike. They had to come in and start buying bonds. They're really trying to extend that soft landing. So I think they're already talking about tapering quantitative tightening.
Well,
I think that happens.
They did it last year during the mini banking crisis that took place in the spring, too.
Exactly. I think they eased policy significantly through that BTFP program. That's running off, but we've got the discount window. I think starting to taper quantitative tightening as those overnight reverse repo levels are coming out, it's very prudent. I would think it starts by March, April timeframe. They start to taper just because now they are finessing. When does quantitative tightening become a problem? Nobody
and
knows.
I just go back and forth. If you're in a situation of using either putting the brakes on quantitative tightening or cutting rates, my guess is they'd want to slow on the quantitative tightening first because the cutting rates is such a public proclamation of a tide, a shifting tide, and they don't, again, want to get caught in a situation where they have to change their minds. After you cut rates, if you have to raise them again, that's a problem.
Right. It's a fair point. Now, the Fed's been saying that interest rates is their primary tool, so they've been saying they're likely to cut before they stop QT. But I would argue cutting from 5.5 to 5, or even 4.5 or 3, is still within the restrictive realm. They're just reducing the level of restrictiveness because inflation has come down. So as long as they can spin the normalizing, and that's actually consistent with, getting at least sort of slowing down the balance sheet tightening as well.